Get started now, and welcome to Class 7 of Justice University's course. Today, we're going to have Mike Graney continuing a presentation on the Economic Democracy Act. This will be looking at some of the key institutions. In the first session was covering the major structural reforms having to do with the money system, the tax system, and the inheritance system. This is going to look into the notions of the roles of the commercial banks, insurance, how capital credit is allotted, the idea of capital credit insurance and reinsurance as a substitute for traditional forms of collateral, and also what is the role of the government, the state, vis-a-vis the Economic Democracy Act and really the just third way. So I'm going to turn it over to Mike now for his presentation. After he's done, we'll open it up to questions from each of you, and Norm, Mike, and I will respond. The second half, if we have any questions remaining, we'll cover those. We did have study questions, and that's to give you a way of focusing so that we cover areas that you read. I'm going to now turn it over to Mike, and I'll have further announcements after the second half or later in the first. Thanks, Mike.
Okay. If everyone would do me a favor, and if you're not talking, could you please mute yourself? Because some of the strangest sounds come across, and I make enough strange sounds myself that we don't need any additional ones. Today's class will be divided into 4 parts. The first part is kind of an extra bit from the last class. It's the brief talk about the insured credit allocations to make people creditworthy. Then the following 3 parts are the role of the commercial banks, then the third part is the role of the central banks, and the fourth part is the role of the state. So there weren't enough, there were too many parts for the last one to fit, so you have that little tag end on there for the end. Now, if I did this correctly, we will share the screen. And I did something wrong. Okay, let's see. Nuts.
Mike, you yeah. Go and open up the file that you did.
It's open. Let me
Okay.
let me get to
Go
it
back
here.
to share. Yeah, you should see the screen that you need to open up.
Oh, I see what I did wrong.
Okay.
Okay. Now let me get back. Okay. Sorry about that. There it is. Now we can start there. And I did both of them right. I just didn't do it completely. I didn't do it the full way through right. Okay, welcome to Class 7 on the Economic Democracy Act, Part 2, which, as I said, is divided into 4 parts. But of course, before we even begin, we just quickly review Louis Kelso's definition of money. Money is a way you measure value. It is not itself something of value. It's a tool we use to measure value and facilitate it, and thereby facilitate exchange and the whole economic process. In addition to what it says there, you can think of money as the medium by means of which it is the medium of exchange. Unfortunately, today's mainstream schools of economics consider money only one of the media of exchange. No, money in the Kelsonian / banking principle economic paradigm, money is the sole medium of exchange because it can take any form that by means of which you value something and carry out exchanges and carry out and facilitate the economic process. At its most basic, money is the way that I exchange what I produce for what you produce. Everything else is a way to make that easier. Now, our first part, as I said, is going to be the insured credit allocation, the insured equal credit capital credit allotments to citizens for financing national economic growth. And this is absolutely critical to the system, because when the moment you talk about credit, you're talking about people being credit worthy. And capital credit insurance is the way you make ordinary people who ordinarily would not be able to borrow money have the ability to borrow money. And money is the way we acquire ownership. Most of us, since we didn't pick the right parents, and we can't go out and stake a claim or be a robber baron or something. Now, the key to the whole thing is that the reason why capital credit insurance is so important is because how new capital is financed determines who owns it. If you own the money that buys the new capital, you happen to own the new capital. That's why we have Mr. Moneybags there. He's going to be the biggest fat cat you ever saw because he has the money. Now, the other bit is, and this is why Kelso and Adler titled the subtitle of their second book was A Proposal to Free Economic Growth from the Slavery of Savings. That meant past savings, because when past savings are used to finance new capital, guess who owns the new capital? The people who own the past savings. Now, what Kelso applied was something from classical economics that had never been used to broaden capital ownership in an economy. Nobody had apparently even thought of it. And that is future savings, which means that you can turn the future stream of income into money now to finance the very future stream of income that will be generated to pay it off. I mean, this is pure genius. And Kelso applied that bit of genius to his own bit of genius and combined the need to expand ownership and make everyone creditworthy to the way of creating basically money out of future value rather than past value. Because when future savings finance new capital, anybody who has access to future savings, which is potentially everybody on Earth, can own the new capital. Now, take these figures with a grain of salt. They are for illustration purposes only. The situation changes so much with the amount of fake, funny money that the government pumps into the economy by the day that we can only use these. This figure is from several years ago, so just use it for illustration. At that time, approximately 2 trillion of new capital is financed each year and was financed in the United States. If you allocated that equally among everyone, that would be around $10,000 per person. It's quite a bit more now, but take 10,000 because it's easy to work with. Now, this is where the capital credit insurance comes in. In order to be able to participate in the creation of new money, or even borrow old money, you have to be creditworthy. That means that the lender or the co-participant in money creation, whose name is on those pieces of paper that the pieces of money that you're going to be spending, is going to be on the hook for, and they want to make certain that you are creditworthy and are reasonably expected to be able to pay it back so that they don't get stuck with it. Now, what that means is that to be creditworthy, you have to have, obviously, a financially feasible investment. We can't finance speculation. We can't finance expenditures or consumption or gambling or anything else. To use this process of money creation correctly, what you're spending it for must have the reasonable potential to pay it back and thereby cancel the money that was created in order to bring it into being. So you have to be financially feasible. Next, you have to have access to future savings. That's not as easy as it sounds, because the third thing that you need is collateral. And this is why they typically say you need money to make money. Well, what they mean is that you need collateral to make money, because no one is going to create money and be on the hook for it unless they're going to get it back. And if you can't pay it back from the investment you make, they want to be able to be reassured that you have some other form of wealth that they can seize to satisfy the debt and cancel the money that they created. Now, what a capital ownership account or an economic democracy account, whatever we're calling it now, instead of using existing wealth in the possession of the borrower to make someone creditworthy, we substitute a legal vehicle that has good character instead of the person itself. We shift it from the human person to an artificial creation called the capital ownership account, sort of like a mini trust, an artificial person that will borrow on behalf of the real borrower. And what capital credit insurance does is it substitutes for traditional collateral. To think of it one way, insurance is a way of renting collateral. In other words, the insurance company has a big pool of wealth. And for a small fee based on the risk of what you're going to be investing in, it will say, we will serve as collateral for your loan in exchange for this small fee, because that's the risk factor. It's called the risk premium. And Kelso thought, well, why not, if it's a risk premium anyway, why not use it as the premium on an actual insurance policy? And what it does is, if it this insurance policy will pay off if the loan goes bad. And this makes certain that the lender is going to be repaid and you don't have unbacked money floating around out there in the economy. And it avoids, and I think that is misspelled, but that's another thing. Avoids inflationary pressure from bad loans, because this is what the government is doing now. It's basically issuing counterfeit money. It's unbacked. Well, if money is backed by a capital credit loan that goes bad, then that turns into unbacked money. And what capital credit insurance does, or any other collateral, is it provides the money in another form to cancel so that you don't have inflationary pressure from bad loans. Now, we had a question the last time about, I think we did, well, what about the shares themselves? What if they go bad? Well, people have had portfolio insurance for quite some time. So what you do is you insure the shares that you have in your capital ownership account from if the value goes so low that they're not generating enough income, then the insurance company will pay off on that, and you can just sell the shares to them. And you can use the proceeds to buy better shares, so that you won't ever be in such a situation that, unless the entire economy goes bad, most people are going to be in good shape, and there's a backup plan for everything. Now, this brings us to part 2 of today's presentation, which is the role of the local commercial and cooperative banks. In essence, that we didn't need to add cooperative banks, but some people added it anyway. So we have to explain what the difference between a commercial and a cooperative bank. A commercial bank, which is also called a mercantile bank, by the way, is a financial institution that takes deposits, makes loans, accepts mortgages, accepts bills of exchange, and issues promissory notes. Now, there are 2 other types of, a commercial bank is actually a combination of 2 banks. A bank of issue, also known as a bank of circulation, which is a more archaic term, and a bank of discount. Now, there are 3 basic categories of banks, 2 of which, well, frankly, all 3 of which we don't have to worry about today, because this is the commercial bank is a combination of 2 of them. There's the bank of deposit, which is what most people think of as a bank. This is where you put the cash in and lend the cash out. That's actually a very crude form of bank, and is actually the newest form, even though people think it's the oldest form. A bank of issue or of circulation, which is one of them right there on the screen, is a financial institution that can take existing wealth and turn it into money. What a bank of discount does is take future wealth and turn it into money. And what some genius figured out about the 14th century in Italy was that if you combine a bank of issue that turns existing wealth into money and a bank of discount that turns future wealth into money, you've got a new type of bank, a commercial or mercantile bank that can turn both existing wealth and future wealth into money. Now, a cooperative bank, which we just throw in here because a lot of people will say commercial and cooperative banks, is a financial institution that is owned by its customers. It can be any type of bank you want because the cooperative describes the bank's ownership structure, not its function. So if you see something described as a cooperative bank, well, you know how it's owned, but you still don't know how it functions. Now, as I said, this discussion covers only commercial banks, also mercantile banks, and they were designed primarily to create money to be repaid with future savings, to facilitate commerce, which is why they're called commercial banks, by merchants, which is why they're called mercantile banks. The British call it mercantile, Americans call it commercial, so it doesn't really matter as long as you know that the terms are interchangeable. Now, under the Economic Democracy Act, a commercial bank would discount or accept. This is the special financial terminology that is used in financial circles and in banking circles, a bill of exchange from a borrower who has a feasible investment and, of course, is credit worthy because he has a line on a capital credit insurance account. And just a bit of trivia here. The first acceptance of a bill of exchange is always called discounting. All subsequent ones are rediscounting. So that when people talk about the Federal Reserve discount window, that's the official name of it, but it's actually a rediscount window. Now, a bill of exchange that's discounted with a bank or rediscounted is called a banker's acceptance. Yet if it's but you can do this in the private sector too, in which case it's called a merchant's or trade acceptance. The only difference is who's accepting it, not what the instrument itself is. I mean, you have trillions of dollars of financial instruments floating around out there that never see a bank. It's, you know, it's what they call the B2B type of transaction, business to business, or consumers and business, or individual people and businesses, or between individuals. You don't need a bank, but a bank is an incredible invention that really helps things move along, because that way you don't have to trust every single person that you come across, and they don't have to trust you. What you do is you trust one institution called a bank. And as long as the bank trusts each of its customers, then all of the customers can trust the bank and everybody else. Now, what's interesting is if you don't have a bank, you're not going to be able to carry on trade very, very well. You have to have a bank. In the early 1830s, in the United States, Congressman George Tucker of Virginia, who is also, by the way, America's first science fiction writer, he estimated that 99% of the US money supply consisted of this private sector paper being traded back and forth that never went even near a bank or was issued. It was not in the shape of coin or even of banknotes. It was in the shape of these financial instruments that bankers or merchants accepted. Now, once a borrower's capital project is accepted by the bank issues a promissory note. What backs the promissory note is the accepted bill of exchange. Now, the difference between one of the differences between a mortgage and a bill of exchange, besides one being past savings and the other being future savings, is that the past savings instrument, the mortgage, bears interest. The future savings instrument, the bill of exchange, passes at a discount. Very rarely a premium, but I've never actually heard of one passing at a premium, but in theory it can happen. But a bank will accept, or even a merchant or someone will accept a bill of exchange, say for $100,000 at discounted 2%, it will accept it for $98,000. When the bill matures, it is redeemed for the full face value, and the difference represents the bank's profit, out of which it has to meet all its expenses and show its profits. It represents the bank's revenue, out of which it must meet its expenses and profits. Sorry, a little slip of the tongue there. Now, as I said, and if the discount is not big enough to meet the bank's expenses and show a profit, but the instrument itself is still good, the bank won't be able to accept it, or it'll take a loss. In which case, it'll probably have to raise the discount. In which case, the borrower will probably go find another bank that offers them a better discount. Now, as I said, the bank uses the promissory note. Nowadays, in the old days, they used to actually print up currency, banknotes, the paper money. Nowadays, it's usually in the form of a new demand deposit, a checking account. And that's what's used. Of course, nowadays, they mostly use debit cards or something, or electronic transfers, but it's the same thing. It doesn't matter whether it's in the form of an electronic impulse or a gold brick engraved with what you want, with what is there. It's exactly the same thing. I mean, legally, all money is fungible, or I should say all currency is fungible. Now, when the borrower presumably takes the money, invests in the financially feasible project, it generates revenue once it's put into work, and the borrower repays the full amount of the bill. And this buys back or redeems the bill and cancels the promissory note, so that these people that are worried about banks creating money and inflating the currency don't have anything to worry about, because if the system runs properly, every cent that is created is then canceled. The bank's profit comes out of other money that is already circulating in the economy that was issued by somebody else. Now, this brings us to part 3, the role of the central bank. Now, we just heard the little part on what is the role of the commercial bank. And that is to be able to provide, adequate financing for the private sector, for its customers. What does a central bank do? Well, just as in the 14th century, some genius figured out how to invented the commercial bank, in the late 17th century, the merchant adventurers of London had the idea of, why don't we have a commercial bank for commercial banks? We don't want to risk all of our banks going bankrupt because we can't get adequate accommodation or sufficient liquidity. So why don't bankers have a bank? This will mean that every single member bank of a central bank can get all the credit it needs for legitimate purposes. And this will make the financial system much sounder. Plus, you will establish a uniform currency everywhere, at least among the members of the central bank. And no bank will go bankrupt if you can get the reserves to it fast enough, in theory anyway. It's sometimes happened occasionally anyway. Now, so where the commercial bank serves private sector customers, the central bank serves commercial banks. Now, what it does is, specifically, it ensures that all member banks have adequate reserves so that they can cover all obligations presented for payment, so that in theory, there can be no such thing as a run on a bank. It maintains an elastic and uniform currency. In other words, every banknote from any member bank is legally and financially the same as the banknotes from all other member banks. And originally, the currency would be stable and asset-backed. It would always have the same value and would always be asset-backed. That is until the government got into it, but that's another whole story that we won't get into today. Now, the main reason for it is that it provides adequate liquidity for the private sector, whether industry, agriculture, or commerce. Back when the Bank of England, the first true central bank, was formed, it was mostly for commerce. The merchant adventurers of London, they were worried about, this was the British Empire was starting to grow then, and they wanted to be sure that they could supply enough money and credit to expand the empire commercially as well as militarily and politically. And an important point that was not originally in, but quickly became part of a central bank's function, was to oversee clearinghouse operations. Now, what does a clearinghouse do? Very briefly, Instead of banks having to deal individually with one another to present their obligations that they collect and then offset with each other, send them to a central clearinghouse where the clearinghouse worries about, each of the individual banks' balances and so on and so forth. This actually prevents a dirty trick that Adam Smith mentioned. And that is, if you want to drive a rival bank out of business, you collect obligations on that bank until you know that it exceeds their reserves on hand, and then you present them all at once for payment. This causes a run on the bank and causes them to go bankrupt. Well, you can't do that with a central bank and a clearinghouse because at the end of every day, they offset all the balances. So you can't collect obligations of another bank and hold them off the market. Now, I use the term elastic currency. What's that? That's simply a currency that expands and contracts directly with the needs of the economy. And this presumably avoids both inflation and deflation. Problem: if you're using the currency principle, which is the one on which Keynesian, monetarist, and Austrian, and virtually all other schools of economics except binary economics is based, what you have is somebody trying to second guess how much money is going to be needed in the economy. Then they print it up and hope that it matches what's going on in the economy. The banking principle, of which binary economics is the sole remaining school of economics that I know of in the world, it links the creation of money directly with the need for money. This is what all these financial gymnastics we were talking about lead up to. No money is created until and unless there is a financially feasible project with a sound present value, or there is actual existing wealth there to back it. So any new money that's created is backed either by future savings or by existing savings automatically, simply because that's the method of money creation. It's not the same under the currency principle, which is the one where you have a bunch of academic geniuses trying to figure out, well, how much money are we going to need the next year? That's a moot point in the banking principle. We don't care. If there's a financially feasible project, you can create money for it. That's it. And it'll be good money, and the value will be stable. It will be asset backed, and you don't need to worry about issuing more government debt because, oh no, we're not going to have enough money. You will always have enough money. Now, how does a central bank provide money or create money, provide liquidity? That is, two operations: the discount window and open market operations. Open up market operations are a very dirty word today because of the way they've been misused, but it is critical function of a central bank. Now, the discount window is the one that you hardly ever hear about because it is also misused, or unused, I should say, mostly. The discount window is it applies to future savings. And this is the part of the bank that accepts or rediscounts bills of exchange previously accepted or discounted by member banks. It's all future savings. Properly used, this would ensure that there is always enough money for agricultural, industrial, and commercial investment. Always. If everything else being equal and everything works according to plan. Open market operations are a past savings mechanism. And what it does essentially is take these big pieces of money, some of which are denominated in the billions, believe it or not, and break them up into little pieces that people can actually use. Very few people run around these days with $1 million bills in their pocket. You couldn't spend it anyway. I think Mark Twain wrote a famous story called The £1 Million Note, where someone was given £1 million note, tried to spend it, and he couldn't. So everyone just gave him everything he wanted. But you can spend ones, fives, tens, 20s, and even 50s. Sometimes they're a little leery about hundreds. But what open market operations do, or are supposed to do, is take these big pieces of money and break them up into little pieces of money if there's not enough little pieces of money in the economy to carry out day-to-day transactions. Or if there's too much little pieces of money in the economy, it buys them by selling some of its inventory of financial paper that it bought on the money market. Open market operations. How it got into buying and selling government debt was an accident of history that we don't need to go into now. Because under the Economic Democracy Act, it would be phased out. I wish we could just terminate it immediately, but you can't. It's like you can't cut a drug addict off immediately, and you can't cut the government off creating money immediately. Now, what we would do eventually is the just third way would restore the central bank's function of maintaining a stable, asset-backed, non-counterfeit currency by phasing out monetization of government bills of credit. A bill of credit is simply a government issued bill of exchange. The difference being that where a bill of exchange legally has to have actual value behind it or you go to jail, a government bill of credit has nothing but the faith and credit of the government behind it, meaning in most cases, the government's ability to tax future income from people that they may not make anyway. So it's kind of a very iffy transaction there. They're also called anticipation notes because they're issued in anticipation of future tax collections. Now, how is the Federal Reserve owned? Currently, it's nominally owned by its member banks. That means absolutely nothing because the federal government controls the Federal Reserve. It does this by the president appointing the chairman and the Senate approving it. So that if the chairman of the Federal Reserve really doesn't do what the president wants, he's out of a job, or she. Now, and this happened in the 1930s, much over the protests of some guy named Harold Glenn Moulton, who said that this is what Italy and Germany did under Mussolini and Hitler and a bunch of other countries, and they're all in trouble anyway. When the government takes over the economy, anything goes, as we have seen. Now, we would, instead of having the member banks own, we would say that all citizens in a region should own. Now, what this brings us to the role and powers of the state under the Economic Democracy Act. Under Keynesian economics, and to a lesser degree, monetarist and even Austrian, the state has too much of a role for what we would like to see. We would like to see not power to the people, we want to see power to people. And since power naturally and necessarily follows property, and since property is mostly acquired these days by access to money and credit, obviously you don't want the state controlling money and credit because whoever controls money and credit, as we saw at the beginning of this presentation, it ends up owning everything. Now, ownership doesn't necessarily mean holding title. The commercial banks have title to the Federal Reserve, but that doesn't mean they own it. The federal government owns the Federal Reserve, whether or not they admit it. And if the federal government can control the economy, the federal government owns the economy. So we want to take the money power out of government hands and put it into the hands of actual flesh and blood people. But what is the role of the state? Well, that doesn't mean we don't need the state, despite what the anarchists and libertarians say, because man is by nature a political animal. That doesn't mean he's individual. It doesn't mean he's social. It means he's a combination of both. He's an individual with rights that are exercised within a social context. And that means that we consciously choose to live together. The difference between a social animal and a political animal is that social animals don't ordinarily, or that I've ever heard of, consciously structure their social environment. Political animals, human beings, do. And that means that the state was not made by God or self-generated or anything else. The state was made by and for people. It was not made by or for the state. And that means that sovereignty comes from the people to the state, not the other way around. There's a terrible scene in the musical 1776 where Thomas Jefferson says all rights come from the state except the right to be free. No, all rights come from people and are delegated to the state, which then defines their exercise. So that powers are delegated from people to the state, not from the state to people. Now, this gives us, within a just social order and a justly structured state government, the four pillars of an economically just social order. an limited economic role for the state, free and open markets, restoration of the rights of private property, and we discussed that earlier, and of course, the whole idea of the Economic Democracy Act, expanded capital ownership. And the principal role of the state is, or should be, eliminating special privileges, monopolies, and other barriers to equal participation by every citizen. And in many cases, every person. Enforcing contracts, policing abuses, and providing a level playing field. And this is what it says basically in the preamble to the Constitution, which I won't bore you by reciting, but establish justice, third line down, second and third word in. And that brings us to the conclusion is that one of the reasons why for the Economic Act, the main reason for the Economic Democracy Act is that you're either going to own or you're going to be owned.